The year 2022 was an eventful one. The war in Europe, exploding energy prices, high inflation rates, unclear whether they have already peaked, and last but not least, an interest rate turnaround by the ECB. You don't have to be a financial market expert to realize how much the market has come under pressure. But like in every crisis, there are winners. A spark of hope. Alternative investments remain robust. AI experienced a sustained boom and increasing importance in institutional investors' portfolios in recent years, also driven by persistently low inflation and interest rates. However, due to the current severe inflation shock, central banks around the globe have raised interest rates to curb inflation, which affects assets through different channels. As a result, stocks and bond markets experienced a historic joint crash. Of course, alternative investments are also impacted by higher levels of inflation and higher levels of interest rates, directly and indirectly through multiple channels. Which leads us to the question, how will the changing environment affect the performance of AI and their relative strategic attractiveness and role for institutional investors? Hence, BAI initiated a dialogue with investors and asset managers to understand channels through which AI are impacted. One result of this dialogue was the investor survey, which you will all be familiar with. However, the topic is too complex to be covered by a survey, and different views of the practice are equally relevant. Therefore, our market analyst Florian Bucher analyzed not only our investor survey results, but also held interviews and personal talks with institutional investors and asset managers with various backgrounds. In our new publication, Interest Rate Turnaround and Inflation, Alternative Investments Remain Robust Despite Competition from Rising Bond Yields, you can find Florian Bucher's analysis and results. But let me give you a quick summary of those results. They are in no way all information of our latest publication. This would just simply go beyond the scope of this video. We see that AI, in total, are defying the current market turmoil with an existing allocation of 23% and a forecastable increase to 26% in SAA. Alternative investments continue to grow and are becoming strategically more important. Net inflows are also expected for nearly all asset classes at the aggregate level, as the allocations show in the SAA are higher than the current allocations. Our data shows this trend is also mostly robust to changes in the interest rate and inflation environment at the aggregate level for all AI asset classes, according to both investors and asset managers. Of a total of 165 institutional investors and asset managers surveyed in our BAI survey and BAI member survey, about 80% of LPs and GPs expect alternative investments will not lose importance in strategic asset allocations due to the interest rate turnaround and inflation. But a more detailed look at the data. Different implications of interest rate turnaround and inflation regarding SAA for different investor types. For example, more than 30% of foundations, church and charitable investors expect AI to increase in importance in SAA, while less than 10% expect an increase in traditional assets. In the case of pension schemes, as many as 37% expect AI to increase, while 12% see the importance of traditional assets rising. Insurance companies are at the other extreme, with 32% expecting an increase in traditional assets and just under 3% expecting an increase in AI in SAA. But there's a problem. Different return targets and actual interest rates applied by different investors and different current allocations. This determines to what extent rising interest rates and traditional fixed income are in competition with AI. In connection with this, the denominator effect has an impact on SAA. To understand the impact of the changing market environment in more detail and gain insight into the practice, our market analyst Florian Bucher spoke with institutional investors and asset managers on the topic. The voices of the investor interviewed during the expert interviews and those who spoke informally are basically in line with our survey results. Although the interviews revealed that higher risks and uncertainties are perceived overall, the fundamental trend toward AI is seen as unbroken. Fundamental characteristics of AI remains present regardless of interest rate levels. Alternatives would therefore be used because they can generate futures or premiums that traditional assets cannot. It should be noted that a high degree of diversification through AI must be ensured in any case. If you want to get insights from practice, you have to look in our publication, which is free to download at our website and at the link in the video description. Investors differ regarding their underlying regulations and targets. A crucial aspect in understanding how the interest rate turnaround and inflation affects SAA is the actual interest rate investors use. During the last decade, the low interest rates put pressure on institutional investors who had to fulfill nominal return targets. Therefore, they turned towards AI. However, due to the interest rate turnaround and rising bond yields, traditional fixed income is gaining momentum again. Various investors and asset managers interviewed consequently stated that under certain conditions, bonds regain relevance. The extent to which possible substitution of AI through bonds impact strategic asset allocation further differs depending on the type of investor and return obligations. While bonds are becoming increasingly attractive for achieving nominal defined return targets, this is not the case for real value preparations or real return targets. If you want to understand the different impacts for pension schemes, foundation, occupational pensions, provisions, and get insights from asset managers, look into our publication and into our latest video series about the investor survey. Looking at our data from the BRI Investor Survey 2022, we can see a convex connection between the share of investors who want to decrease the allocation in a certain asset class and the expected return of a certain asset class. Therefore, a higher share of LPs tends to reduce the allocation in those asset classes with comparatively low expected returns: real estate debt, real estate equity, infrastructure debt, under a certain threshold of about 5% expected return and less risk. This could be explained by the fact that traditional fixed income is emerging as a competitor for those asset classes. This seems to be not the case for infrastructure equity and corporate private equity. Also, for corporate private debt, only a small share of investors wants to decrease the allocation, despite possible competition from traditional fixed income. It must be noted that there are considerable differences within the asset classes regarding the expected return, depending on the strategy, which is not reflected in the aggregated survey data. Regarding the link between the share of investors who want to reduce the allocation and the average expected returns, the only exception is venture capital. With a very high expected return, this can be explained by the comparatively higher risk of the asset class with more insecure returns in the future. The more pronounced the risk profile, the greater the discounting required for future earnings, the greater the reduction in the present value of an asset class. It also appears from the interviews that if the interest rate turnaround and inflation play any role at all for SAA regarding AI, it is primarily about new capital inflows or shifts within asset classes. Major shifts will only be seen when fixed income yields rise to higher levels of about 6 to 8%. Another aspect has been increasingly brought into play with GPs and LPs when discussing reasons for potential shifts in SAA is the denominator effect. This so-called denominator effect plays a role for those investors who no longer can increase AI allocations or even must reduce them. Traditional investments, equities and bonds, lost massively in market value in the course of the developments this year, which in turn automatically increased the importance of illiquid assets in allocation without active adjustments. Liquid assets must be valued market to market immediately. While many liquid markets had massive losses in 2022, illiquid ones have not reacted as quickly. Those who are subject to invest quotas or regulations regarding capital requirements in AI can be inhibited, allowing less room for new capital commitments. Overall, based on analysis and the interviews, we can assume that the denominator effect is likely to be only temporary and not that no long-term impacts are to be expected for SAA. Looking at our data, we can see investors with relatively small amounts of assets under management expect increases in AI allocations due to the interest rate turnaround and inflation, while bigger investors see rather increasing importance for traditional assets. The fact that bigger investors expect decreases in AI allocations could be explained as a result of the opening of their portfolios towards AI is already very advanced. Thus, they are also limited by the denominator effect in building up additional allocation. The fact that investors who expect shifts in SAA towards traditional assets have a significantly higher current allocation to AI also supports this argument. Since the BI Investor Survey 2022, our forecast for the AI quota for the average investor is 26% in the SAA, we can observe a possible trend matching effect. Investors, on average, seem to converge towards this quota. Well, this video was longer than I was expecting, and this wasn't even all results we collected out of our investor survey and the interviews with GPs and LPs. I strongly recommend you to read the whole article. Alternative investments remain robust despite competition from rising bond yields. And I also recommend you to have a look at our YouTube channel. There we upload all kinds of videos like this one. You can find the links to our paper and to our video channel in the video description. See you in the next video.